Greetings and welcome to another episode of the Truth About Real Estate Investing Show. Back for his third appearance on this show, my business partner in the USA, Andrew Kim, tech entrepreneur turned real estate innovator and investor. He owns 20 properties in the States, and this time it's different. Even though we're friends, I'm only welcoming Andrew back as he has new information to share, which is to help Canadians generate wealth and retire early via passive US real estate. Any real estate. I don't really care where it is. I'm just looking for optimal solutions that provide preferably as best as possible returns with as least as possible risk and effort. Anyways, it's a strategy I've never heard of in Canada, but made popular in the States. It's called Subject To, a strategy investors use to assume seller mortgages to skip the entire financing process. You don't even have to speak to a bank for this process. And the objective is to obtain a lower mortgage rate, and in turn, people can save tens of thousands of dollars, including hundreds or thousands every month in interest expenses, and thus improving your cash flow. And of course, in turn, you don't have to put down as much money. Andrew is the founder of Share. Andrew manages over 20 properties of his own across 4 different states without lifting a finger. How? By combining Silicon Valley grade technology and artificial intelligence, institutional property management, and creative deal structures, including Subject To and what's called seller leaseback. I know we're getting into a lot of terms. Seller leaseback is when the seller stays and becomes the tenant, hence releasing back to the seller. These are strategies most Canadians have never heard of, and we're in this episode we're going to deep dive. So we're going to go way beyond the basics. We're going to talk about how Subject To and leaseback deals are creating passive cash flow, including Canadian investors. The majority of my clients who are doing state deals in the States are doing Subject To deals. Who can blame them? We're going to talk about why institutional property managers will refuse to manage certain types of deals, and what does that tell you about the investment? And we're going to talk about the truth about some certain Canadian tax myths, foreign exchange risks and fears, and how Share simplifies it all. And for those who are interested in learning more, we do offer a free guide to Canadians to invest passively, yet keep 100% of the ownership and 100% of the control. And simply go to http, I have the link in the show notes, iwin.sharesfr.com. Now, again, why I clarify and mention keeping 100% ownership and 100% control. Also understand that we at Share, we specialize in nice neighborhoods. We don't go to those ghetto neighborhoods that I know many people are flocking to these days. Anyways, the point is, I've seen so many people lose money in real estate. One of the factors is they lack control of the property. One of the other main reasons is the property is located somewhere where the real estate sucks, as in prices are low, and they're low for a reason. Rents are low, and they're low for a reason. That's not what we focus on. Hence, I specify we're focusing on nice homes, nice neighborhoods, 100% ownership, 100% control, so that you may stay out of trouble and preferably make some good money, get rich investing in real estate. Please enjoy the show. Hey Andrew, what's keeping you busy these days?
Just building and scaling Share. We're trying to, our mission is simple. How do we help everyday investors generate wealth and retire early through real estate, through US real estate?
So how do you balance this? You have 3 young kids and you have a portfolio of 20 properties in 4 different states, is it?
Yes.
So these are hundreds of kilometers apart, these properties.
Yeah.
So you didn't mention that. How do you, just on the weekends, you drive between them to check in on them, collect rent, whatnot?
No. So, we built Share out of my personal necessity because I started real estate investing back in 2011, started in Florida. And then, fast forward, let's just call it 10 years, realized it is a lot of work to grow your portfolio. And I was very inactive on my initial portfolio, realizing that, the only person responsible for building and scaling your portfolio is me, because my property manager clearly did not raise my rents, was running away with my budget, and they don't know what my financing strategy is, what my equity is. So they're not responsible for growing my portfolio. So that's how Share was actually born. I needed somebody to focus on building my portfolio as opposed to just maintaining it. And that's why we built Share, introducing the concept of this asset manager who is there pulling the triggers, understanding the levers, and bringing the ideas and path forward to actually grow the portfolio so I can focus on my personal and professional life. So yeah, it's growing. I'm using Share as, eating my own dog food, and that is they are managing my portfolio.
Mm-hmm. It's funny you call it eating your own dog food. When people ask me how my property in San Antonio is going, I'm like, I hear nothing. I get an email every month. There's positive cash flow. This is my favorite real estate investing experience personally. This is like some premier dog food.
Yeah. It's so funny because it's like as soon as it gets stabilized. When I say stabilized, like there's a tenant in there, they're paying rent, and we're all ready. The client often disappears, and then it's like, hey, tax season, we're back here, and it's like, oh yeah, I forgot about this investment.
Right. Well, I was lucky because my property came with the tenant stayed, the seller stayed, so my tenant was there from day one. I'm collecting rent day one.
Yeah.
And I did nothing.
Great strategy, great property.
Yeah, love it. And Texas is apparently poised to do well going forward. Yeah. But before we talk about more in the real estate, can you tell us more about your tech background? Because you have a very different background than past guests of the show. Yeah, just tell us about your tech background.
I actually started my undergrad in IT, but quickly realized I did not like to code or look at anything mechanical or mathematical. I actually just wanted to focus on the business. But I spent my career working on consumer products on what they call like a product manager role, which is the intersection between, it's the middle person that has to listen to the customer demands, the business demands from the top down, and then working directly with the software developers or engineers and balancing them, saying, hey, well, this is more important than another thing, let's build it like this. So I understand tech pretty well. I can look at some code and understand it, but I am the translator between the tech and the non-tech, and understanding how all tech works and trying to apply that to solve big problems. And how it works to my profession is that I've built and sold my previous tech companies that were backed by venture capital firms in Silicon Valley, and Share is by virtue a tech company, and we're using tech to solve complex problems so we can actually help more people more efficiently.
Tell us more about how Share has enabled scale through technology and the relationships that you have. Because like what I was telling you before we're recording is this is completely foreign to most Canadians in being able to scale. Because again, we've actually over 400 episodes of the show now since 2016. The only way to be passively operational in Canada is basically to have a partner, either a REIT or someone who is going to basically run everything. You write them a check, you trust them, and of course they take equity like 30-50%, right, and they take a large ownership of the deal, whatnot. And that's pretty much the only way I've consistently seen for Canadians to be operationally passive. Right. Like you've seen it as well when I tell people, oh, Andrew owns 20 properties. They're like, how do you get to 20 properties? Versus with Share, that is completely normal.
Right? Doable.
Completely doable. Like,
yeah.
Tell us about the automation and the tech and the how you've enabled scale.
Yeah, so I think there's like a good solid line in the sand that we can kind of call before and after. Let's call it before AI and after AI. So I'd say before AI, what we're doing on the back end is everything we do in terms of all the services we bring in, financing, underwriting, like quoting, understanding data, like criminal score for houses, like crime, neighborhood, population, all that stuff. And then working with other service providers. There are large service providers in the US that don't work with small mom and pop individual retail investors. And they only service these large institutions like the Blackstones of the world, where they're buying billions of dollars of homes every year. And those large institutions need process. They need to have a very efficient way of, working with them and communicating. So we use technology to really plug into a lot of their systems to aggregate and communicate on a very efficient level, and then pass that through to our clients. So instead of having to pick up the phone and talk to one plumber or whatever, they have a system internally that aggregates all of their operating systems or all their operating partners. Imagine if they're in multi-state, they've got 100 different zip codes they got to deal with. That could be 100 different partners. They have their aggregating system, but we, for that us to communicate efficiently, we would have to integrate to their system so we can pull that same information in real time, allowing us to understand what's happening across the board. So let's call that the traditional technology integration world, where we can now see what's going on at a per property level with all of our partners.
Right. And this costs a lot of money, does it not?
Yeah, I mean, engineers are expensive.
So even the data feeds, are they not
expensive?
expensive?
Their data feeds are like, even if we're pulling a lot of third-party data, and I think that's also a major bonus is, in the US, there's a lot of publicly accessible data, but it's really fragmented. It's very, let's call it dirty, and you have to clean it, what they call scrubbing, aggregate all of that, and analyze it. So you need not only just the technical chops to integrate it, you need the mathematical minds to clean that and compute it, right? To understand that. And again, a lot of those things aren't available to everybody. So unless you are an institution or some sort of real estate organization, these types of services are gated. But because Share is a quote-unquote institution, we can tap into those service providers, because what we're doing is aggregating all of our client portfolio and saying we're bringing it all one shot. We're an institution with many doors. Please give us access. So that is like let's call it the traditional tech world, where we're doing a lot of integrations, doing a lot of math and assumptions and real-time tracking. Now I'd say post-AI, it's now we have an ability to communicate like through text and verbal with an interface like your phone or your computer, like with ChatGPT, and make assumptions and have more non-technical people pull up information, right? Because this will get a little too technical, but a lot of this information exists in big databases that are not as easy to use as Excel. You need to code to get this information. But now we have this ability for the whole team to look up, hey, when does this entity X in Tennessee have to do their tax filing, or when is their franchise tax, or when is their entity renewal? And they have this full conversation behind the scenes that a non-technical person can do. So now we're scaling not only the amount of properties we can manage, but how many like intelligent minds, like properties one human can do behind the scenes, right? Like, for example, an institution, one person on the asset management side may be able to manage 100 doors, but now with AI and all of this technology, they might be able to do 1,000 doors. So that's what I would sort of delineate as, this traditional tech world, and now this post-AI world.
So you have to understand, like this, so all investors are used to being told, do your own due diligence.
Yeah.
It's basically on every real estate listing. Here's the numbers. You do your due diligence. And unfortunately, I've seen a lot of people fail in this area.
So we,
as an individual, but again, like first of all, as an individual, say you're looking at, say you're Andrew Kim and you live where you do, and then you see a listing, and like you're expected to do your own due diligence on a duplex, for example.
Yeah.
Like, what are you gonna do?
Yeah.
You don't. What resources are available to you, and then what's your experience level, and like compared to what's available to you in the States.
Right.
In your company.
Yeah, exactly. Like, I think that's a good point. Like, you could fragment all the data points. Like, always, what is the rent there? You're going to look on, some of these rentometers and whatever sites. And what you have to understand is their data logic and their data access is probably different and maybe not proprietary. It's all public information, right? But now, where we're a bit different is, we're using some institutional property managers, leasing agents that don't publicize their information. So they have some of the most accurate data points that aren't publicly accessible, that we can quality control. So we do that on a very deep level. So we do both quantitatively with whatever data sources we have, economic data, housing, leasing, and then getting our subject matter experts to chime in to actually tweak that out. And then one specific example is like property taxes. This is where we see like 80+% of our clients or partners missing their pro forma, their underwriting, their forecasting. They always often take the existing property tax and say, hey, this is what it is. But over 10 years, they're missing that every year even more aggressively. They take the property tax that is in place right now that they probably grabbed from the previous sale, which was 5-10 years ago. And then they just maybe have put like a 2 to 3% increase year over year. What they don't realize is when it sells, the tax is going to probably get reassessed. And in the US, there are so many different tax, let's call it, not laws, but different privileges in state to state, county to county, city to city. So depending if it's owner occupant, if you're a veteran, you're disabled, you're a senior, or you're a tenant, all these different tax laws come into play. So we actually pay for a third party to actually forecast taxes on a address level, not even a zip code, address level, so that we have that kind of accuracy, because I think it was like 60% or 80% plus of property taxes over inaccurate and over assessed. So there is this huge world of reassessing your property tax, and we monitor that. We pay a third party and we track that on a regular basis. And if it gets reassessed at a higher level that we think is necessary, we will actually go out and appeal it on your behalf and get that money back. So very specific detail, but worth mentioning.
Makes me think of two things. Like how many states are your properties in?
4.
You're in 4 different states.
Yeah.
How many zip codes or postal codes, as we call it? 4? More than 4?
Yeah, 100% more than 4.
What I'm trying to allude to is like, how would you possibly manage 20 properties, just even the tax wise?
Yeah, exactly.
Without help.
Without that service, right? Like my service is watching my property tax on all 20, because again, down to the address level, right? And then you're talking entity structures, because you have an entity in each state. So now they're maintaining my entity. So our system's actually logging that. And like, imagine doing that on a basis, because some of these states, they're still, for your entity or your tax, whatever annual assessments, they're taking a digital copy of a picture and sometimes emailing it or mailing it to you. Our system will take that PDF and analyze it and then put it in the system. And if there's an action, we'll actually take the first step on your behalf, figure out, is it urgent, not urgent, and then bring it to your attention and say, here's your course of action. So you don't have to stress out about all of that stuff.
The other thing that made me think about is property taxes here, and all they do is go up.
Right.
And then we can't raise our rents to cover our increasing cost of business.
Right.
It's funny, I asked ChatGPT a question a week or two ago. Would Warren Buffett ever invest in Ontario real estate? and then it came back with, Warren Buffett would never invest in something where he cannot control the price.
Right.
Right. So just another jab at Canadian real estate.
Yeah.
Not all places, obviously. I'm just mostly BC, Ontario, Quebec are the most populated provinces. What else shall we talk about? Yeah. Because I find a lot of, especially new investors, they don't think beyond the first property or first 3 properties and how they scale. Like financing here is tough to get past 3 or 5 properties versus like we've talked a lot on the show as well for small investors. What if someone, and before we were recording, I mentioned how there's a group that went bankrupt. They invested in Northern Ontario. They were doing like 100, 200 houses in each of these towns. If someone came to you and said, I want 100 houses in Atlanta, Georgia, could you help me?
Yeah, 100%.
How would that look like? Because I throw out that number as well, because we just had Ben on the show, our new vice president at Share. And this was like the norm for companies like Share before all this tech advancement, and now you bring it to the everyday person. It used to only be for family offices with $50-80 million to deploy. Yeah. So like this business is designed for scale.
Yes, 100%.
But it's also, thanks to tech advancements, it's available to even the person just buying one property a year.
Yeah. So, how would that work is, maybe, and then if you want to re-guide my response, but...
because we don't want to say no to the people who have like $50-80 million to deploy.
Yeah. I mean, we treat the family office exactly the way we would do our client. It all starts with understanding what we call the buy box, which is like the parameters of your returns. I know we say buy box and it sounds like an individual house, but it does kind of ladder into that. It's like, well, what kind of returns are you looking for over what period of time? Mm-hmm. Is this something you want to hold indefinitely, because family offices are a little different, but like I'll just treat everybody the same. But let's just say they want to sell in 10 years and they want to reap the maximum sort of appreciation on that home, on that portfolio. So again, we do buy box discovery and say, hey, look, if you're an appreciation play, maybe these are the types of houses we go after. And if we stay in one particular market, this is sort of the diversification we'll try to go for in terms of zip code placements. We treat every client like an institution. It's understanding your buy box and your strategy of what is your end game here and how do we actually approach it. And then that ultimately boils down to also financing strategy. Are they going to pay all cash, or are we using a much bigger lender? I think that's the difference between, a traditional small investor who wants 1 to 2 units versus some of these large family offices that want to deploy 8 figures. We can unlock much bigger financing options for them because they typically have seasoned history. But we can do that same thing with our 1-2 unit holders. Once they build a track record, we can unlock great financial products.
Now, which markets are you preferring? I get that question pretty often. Actually, very early in the discussion, which I find interesting.
Yeah.
What are your favorite markets?
Mine personally, the States are Texas, Georgia, and the Carolinas. I would say personally, I like Atlanta a lot, just because the price points are so good there. The population growth is there. And for me, I think the job diversification is well diverse, really diversified. I think what a lot of people look at is, population growth or whatever, jobs are great, but what you got to do is you got to look at the pie chart of the different industries and make sure there's a ton of little slivers versus one big chunk in there, which I think is the common sort of example I give when people are like Alberta or US or Texas or whatever, and like oil and gas is a big chunk. What happens if oil and gas goes under? It might be another sort of Detroit scenario during the automotive crisis, right? You want to diversify for job market.
Yeah, I was just reading, like I told you, I was talking with Grok this morning, predictions of the Canadian dollar and the economy. And I asked about predictions for the Canadian economy and the dollar, and I should mention with weaker oil prices, that's not a good sign for our dollar or our economy.
Right.
Yeah. Anyways. Now let's talk about some of the things that I see, at least I see on social media. U.S. investing is becoming more of a popular topic, and I've always been. Yeah, it's funny because I've always been a Hamilton investor, but I like to say at least we were in the better neighborhoods. we were the nicer homes in the nicer areas of Hamilton. While I see a lot of what's being promoted on social media and other people's advertising is they're in the rougher homes. So I've been in this for a long time. I've kind of now seeing what's available in the States. Certain things are become non-starters for me. For example, I don't do old houses anymore. Mm-hmm. Right? I've just had too much experience of too much capital expenditures, deferred maintenance, and more things just break all the time. Really hurts your cash flow. But I see it's a very popular strategy among Canadians that are going to the States. Maybe it's a proximity thing because a lot of people are, at least for Ontario, I see a lot of people going to Detroit and like Cleveland, Ohio. What are like, so you understand this market quite well, the States in general. What do you see Canadians doing right and wrong?
Oh man, where to start? I think first and foremost, if drive time is part of your sort of formula to invest, it's kind of dangerous. Like proximity and convenience, like that's maybe not our client. That is a client who wants to be hands-on and very focused on that. That's fine. But in terms of like picking the right markets for your interest and risk tolerance is far outweighs drivability. So at Share, we take on 2 clients. One, they start at the very beginning where they want to purchase through us. And then the second one is what we call BYOPs, like bring your own portfolio. So they bring their own portfolio.
They're
from.
existing landlords.
Yeah, and they're
done
yeah.
dealing with it.
Yeah, and it's like I prefer those clients because they've already seen the hardships, and I think one factor of currency that they don't have enough of is time. And when there's actually quite a few Canadians that have 1 to 10 units in the U.S. and they've done the certain pockets in Ohio and then in the Michigan border region. They're from Ontario, typically from the Greater Toronto area, and the drive time with them was the appealing factor. But now they've just time pressed because some of the neighborhoods that they went after and the programs they went through were because they're vertically integrated. And what vertically integrated means, like, it's the very traditional method of I'm a realtor or I know a realtor in this particular city, I know a contractor, and I'll do your property manager. So now it's fully turnkey. But I am pushing all my clients to this one particular city. And they're really good marketers, and you do go there and you realize, look, it's probably for my risk reward appetite, not the right metro, but probably the right metro for somebody who's maybe got higher risk or low risk, whatever it might be. But I think if you're going to do any remote investing, get rid of the idea of drivability and just make sure you're finding the right risk reward profile. Because I think what we've even seen from a lot of clients that we've inherited is that they were kind of sold on these cash flow dreams of these drivable homes, but realizing later on that these neighborhoods are high risk neighborhoods. And if anyone's curious about what that means, is we kind of divide everything into A, B, C categories of our homes. These would be like C and D categories where, cash flow when stabilized and not have any hiccups is great from a percentage perspective of purchase price to cash flow yield. Appreciation typically not there, but it is a higher risk because the tenants are a higher risk tenant. So I'd say biggest concern for anybody is really understanding your risk reward appetite and understanding how that relates into the type of home you're getting.
You said more than a mouthful. Because even my own experience, like when I was in Atlanta, for example, I've been to Atlanta a couple times now. Like nobody lives downtown.
Yeah.
I remember when we were there, I was looking around and I forget who I was talking to. I was talking to my friend Sam. I was saying, there's no condos here. Anything that's high rise is either a corporate office or a hotel.
Right.
It's as if nobody wants to live in the urban area. And that actually shapes part of share strategy. And always been my strategy as well, is to try to stay out of the older urban areas just because that's generally where crime is. Yeah. And we're talking about like Cleveland, for example. Canadians are complaining about crime all the time. There's a big election issue. Check what the crime is in Ohio. I think Cleveland's crime rate is like 8 times of Toronto's.
Yes. Yeah.
Right. So we're talking about risk reward. Like this is folks need to quantify these risk rewards here.
Yeah. And I personally own a lot of these C homes too, but that's how I was sort of introduced to the real estate. I did go the traditional path of, hey, I knew a realtor that did these turnkey homes, but specialized in 2 particular geographies because that's where they lived and that's where they had a property management.
But also the year as well.
The year,
because we're talking about like early 2010s.
Yeah,
2011. So the tech didn't exist.
Yeah, the tech didn't exist. But even still, the onus was on me as an investor to maybe investigate more markets, even if it meant manually. But I didn't do my best to say, hey, well, it was just more of it's turnkey and I'm a busy individual, right? So, yeah, like a lot of investors fall in that pit hole. You just got to do your own independent research.
Now, our share focuses generally on like suburban commuter areas. Can you explain why?
Yeah, we want stability, and we're again focused solely on long-term renters. And what you find is the closer you get to the urban, core centers, obviously the price point gets higher, but you have more transient tenants, right? Younger, and what we want are long-term tenants. We want families, and families want space. They want the 3-bed, 2-bath. They want they want a driveway for their car because they have to drive to work. So we do focus around major metros, but the drivability, like the suburbs, the commuter towns where people are actually driving into the city or have access to the city, or may have a decent job market itself in that metro. So we're talking anywhere from 20 to 50 miles. So that's what, like 40 to 70 kilometers from the core, that people will be willing to drive into the city for. But if you were to look at the Greater Toronto area, that would still be way too expensive. Now we're talking even further out, things like Windsor, right, in relation.
Now, back in like 2010, when I started as a realtor helping clients, even so, let's take it back to even like 2005, we were buying houses regularly, like 100,000, 200,000, and then we didn't want to have to do much. Like we could still cash flow a single family home. And then what's happened through time is, as affordability got worse, cash flow got worse, then we did these other more advanced strategies like student rentals, basement apartments, garden suites, Airbnb. Why is that not these strategies? I don't know. You talk to it.
Yeah. Like,
why not these strategies? Because I'm sure you hear from Canadians all the time. Oh,
100%.
Do I suite the basement?
Yeah, they're like, we're looking for value add. I'm like, define value add.
Yeah,
like,
yeah.
I want to put an ADU in the backyard. I want to rent a basement. Yeah, garden suite and renovate the basement. Like, first off, we don't have basements in some of the houses, but what we saw during the sort of pandemic was sort of an additional stamp of resiliency on the single family. First off, a lot of people that lived in multifamily left and wanted and sought single family because they want space, right? The reason why we're doing single family in these regions is because, again, they're way more stable than stuff in the city. And typically those single family is the least risky. Anything above that, midterm rental, short-term rental, garden suite, basement apartments, duplex, you increase the level of risk, and it's the geography too. You want to, for those things to work, you are probably closer to the core of the city. So that's why, like in the suburbs where we are, just outside the major metros, families are going there for isolation and silence. They don't want anybody in their backyard, and if they do, that it will deteriorate the sort of the amount of money you'll get on the main house and the ADU. So it
works out to be a poor investment.
Yeah, and that although those strategies are great, and just like the sort of risk reward, greater the risk, greater the reward, same thing follows. If you want to go closer to the city and do an ADU, do a garden suite, do the basement apartment, by all means. But now you are dealing with multiple tenants, and now is it the highest quality of tenant, or they're like, what is the quality of tenant? Are they going to get into each other's faces and then they all turn each other over? For us, that's more high risk. Just like short-term rentals, like an Airbnb, it's higher risk. Yes, in theory, there's supposed to be a higher return, but you've got to be more highly involved and be ready for things to crumble.
When I bought my own San Antonio property, I was just surfing realtor.com or Zillow, I forget which, and I came across a bunch of purpose-built side-by-side duplexes. So for here, they look like semis, they look nice. And then I noticed one of them took like 18 months to sell.
Yeah.
And then I noticed that the rents were quite low. And then I just did the math. Like the duplex rent was a less yield as a percentage than my single family home.
Yep.
So again, while we're here, like the novice thinks, oh, if I have more units to rent, then I'm more diversified. I can protect the downside.
Yeah.
What are your thoughts on small multifamily?
Yeah, we have a very specific view on this. Like multifamily in general, if you want to get, I know you're diversified, you got more doors.
Yeah.
But again, it's
if you lose one rent, you at least have somebody paying the mortgage.
But it's also the quality of the tenant. If you aren't, it's all about the location of a multi. In my mind, you want quality multi in an area where multi is warranted, right? Like in the areas that we are finding single family, if you were to put like let's call it, let's backtrack. So single family, we have this ABC category. Let's just say we have a B class single family, which is called 250K. If you were to
tell us more about the property, because 250K, if someone saw 250K in Canada.
Okay. So these would be like the homes we saw.
It'd be condemned.
Yeah. these would be like the homes we saw in Atlanta, like less than 20 years old, maybe even new construction.
Yeah.
250,000, 3-bed, 2-bath, probably just around 2,000 square feet.
Yeah.
Okay, probably getting around $1,900 to $2,000 a month in rent. Family oriented.
Yeah.
Like look at any of the homes on our site.
But just to pause you there, we're talking about like $100-something per square foot for a house.
Yeah.
I try to bring things back to square footage, dollars per square foot, because it's a common metric for condos.
Right.
Right. A condo today in Toronto, for example, would get a really banging deal. It's like $1,000 a square foot.
Yeah.
Here you're getting a house. What was the square footage you said?
About 2,000.
About 2,000 square feet for $250,000.
Yeah.
Right.
So you put that into context now, right? Like,
and that's someone's middle class starter home.
yes. And now you see a lot of multifamilies, or at least the small multifamilies that are, let's call it 50,000 per unit. So let's just call that $250,000 single family home. Now you have 5 units at $50K each, so $50K a unit. I would bet that the single family would outperform that multifamily just because the transient nature and the high churn of that tenant in a 50K home. And that typically that house, that multi, would not do well in that same neighborhood as the single family, because you're probably not getting that kind of tenant first off there. That multifamily is probably closer to the core. And then that tenant doesn't have sort of the same credit or buying power, and like let's call it income stability, as a single family tenant in the suburb. So if you are going to go to multi, we do highly suggest that you do go to the upper ends of the institutional multi, where on a per unit level it's higher or equivalent to the single family, but in the core, because that's where now you've got a higher tenant quality and you've got true diversification.
Right.
But those now are super expensive. You're talking 8-9 figures to get into.
No.
Yeah.
And we can talk shared support still does support 1 unit to 4 units.
Yeah, we do 1 to 4, no problem. Again, the 1 to 4 would be not like, we would avoid going into the C and D per unit costs, because we know that diversification there gets chewed up with your vacancy, your high turnover rate, and the repair maintenance that will go into it. And we've run the numbers a million times.
Yeah, because in talking to Dimitri, our CIO, and talking to Ben, who was on the show, they're talking about, because it's so different here in Canada. So at least in Ontario, for example, we want turnover so we can raise rents.
Right.
It's the exact, seems it's like, I was just reading on Twitter, a gentleman, a U.S. real estate analyst I like to follow, and it always seems to be very popular key performance indicator is retention, tenant retention. They want to keep their customer. Yep. They do not want turnover.
Exactly.
Right? Because turnover means you have to usually clean up the property.
Yep.
Like at least a paint, at least a clean, maybe changing some flooring. That costs money while you're vacant and not collecting rent. It's versus like that's what we want in Ontario. Yeah,
that's crazy. Yeah, we want the tenants to stay. I mean, we do 12-month leases for that reason.
So what value adds does Share look for?
We look for, I mean, the deepest we go is we'll take a house down to its studs. We won't do anything structural, meaning like we'll take all the walls down, not like the drywall, and then redo walls, but we won't move walls. We won't do anything structural.
Because then you need permits.
Then you need more permits. Yeah. And then, we don't underwrite to shrinking the rooms. Typically that strategy like is closer to the city where it's like you can possibly rent out per room, but no, we're single family, 3-bed, 2-bath, very formulaic.
And what are Canadians saying? Because you speak to lots of Canadians, and this is hilarious because you are Canadian, but I drop nuggets on you all the time that you're not really about Canada. Yeah, the one that in the case of the listeners, I told Andrew just last week how Airbnbs in Canada are they're considered hospitality, so they're considered commercial property. So when someone sells an Airbnb property, they have to pay HST on it, right? Which was news to you. Yeah,
it's funny. I think I come to you to learn about the Canadian real estate market. Yeah, even though I live here. But yeah, that was a jaw dropper for me. I didn't know that.
Yeah, or just and then what I added to that was your options to invest in Canada for residential real estate just keep shrinking, and already affordability is just so bad.
Yeah.
Right. But we're just having legislation just cut off, like you cannot Airbnb short-term rental in these markets and whatnot. And now from a tax perspective, and now you can't deduct. Yeah, in areas, you may not know this, in municipalities that don't allow Airbnb, the federal government has even said you're not allowed to deduct expenses against Airbnb income.
Oh wow.
If you're in a municipality that has an Airbnb ban. Did you know that one?
No.
Yeah. So what are Canadians saying?
I mean, there's so many. I mean, Canadians are so conservative on investing. It's insane. But I always have to give them.
I do think it's part of an educational thing.
Yeah,
it's just because it's such a foreign thing to them, because we still hear like the people think they're gonna be double taxed.
Yes.
People think there's a bubble.
Yeah.
Which I think is fascinating, because you need to look in your own backyard first for a bubble before you look at the States.
Yeah, I'll actually spend time on the bubble thing, because like majority of our Canadian clients are coming from Ontario, BC, and Quebec, where housing prices are well above the national average, right? And they're constantly investing, like even beyond the Great Toronto area, the Vancouver area, and Montreal, like outskirts. But that price point still has a large reach, right? Like Windsor homes are Windsor's like 4 hours from Toronto, but it's still very expensive, right?
Yeah, it's pretty sure average home is still over 600,000.
Yeah, so I think when they think price bubble, they are always bringing that sort of sense back home. And that's the same with our clients in the US that come from like New York, San Francisco, and LA. The price points are very high for very big geography, like circumference. Where you see the bubble is actually in those major cities, right? Those major cities drive up the national average. They're well above the national average. The national average in Canada is like just under 700,000 Canadian. In the US, it's just under like 350, or just around 350 US, right? So, right, there's a big price difference. But those cities are the ones that make that line move. Where share focuses on, and what I constantly have to remind people is that the reason why single family rentals, the SFR, as they call it, asset class, is an actual bona fide asset class. It's not just any detached home. So if you go to Wall Street and say SFR, they all understand that as an asset class, and they know it's not just any detached home. It's particular in a specific price range of 150,000 to 375,000. So I would say upper bound is around the national average in landlord-friendly states and in metros where there are strong economic fundamentals. And it makes the home price hyper resilient. So throughout the last few years, the markets we're in, the prices didn't drop. They continue to appreciate. They just appreciated slightly slower, but they appreciated, and they've held true to the principle of resiliency in real estate. Rent rate goes up, but the price points just appreciate slower. So if you're looking to hedge and potentially get into this post 08 opportunity to buy, it's now, right? So yeah, like that is the biggest, I think, misconception. Everyone's like, oh, we're bubbled. I don't want to start deploying my capital into single family in the US because there's a price bubble. It's like, actually, our price points don't go down. Supply is extremely limited still. And people still need a place to live. So this price point has not moved, and it continues to go up.
Can you elaborate more why you think now is the time to be buying in the States?
Yeah, the price points are, as soon as like market shows any signs of improvement and bull run, these price points are going to skyrocket. They were on a great run even pre-pandemic. They were increased in like strong percentages year over year, and that's typically what happens in an up market. These homes typically appreciate faster. People will want to, because you've got such a strong demand base for it, meaning like owner occupants want to live here, small investors want the home, and then big institutions also want the home. So now you've got three kind of groups bidding and driving that price up in an up market,
Right.
right? And then in a down market, the rent rate kind of goes up. So where you want to buy is when appreciation is slower than normal, which is now, right? Again, because rental demand is still so strong. So now is the time to get in. You know, as soon as interest rates start dipping and inflation starts cooling, then you're going to start seeing more buying, and then more, you know, prices are going to go up. So if you think foreign exchange is going to be an issue, it's going to those savings are going to chew itself anyways on appreciation.
Can we talk about subject 2?
Sure.
So one objection that a lot of Canadians have is they see the sticker shock of the interest rate, mortgage interest rates.
Yes.
Because it's usually a 30-year term that we're looking at, so it's usually a rate over 7%. So it's not something that Canadians are used to looking at.
Yeah.
I think it's partly the reason why they afford that's partly why our housing has gotten so crazy, is because we have cheap financing in Canada,
Right.
versus it's not the same in the States. Now, I've told some past clients of mine who are more advanced, who are more experienced, and they say the same thing about interest rates, and they said, "Have you heard of subject 2?" I'll leave that to you.
Yeah.
Tell us about subject 2.
Okay, so subject 2 deal is where the buyer is taking ownership of the home, so the title will change to the buyer's name, but they're also taking on the seller's mortgage, because that seller has managed to lock in an incredible rate. And in the US, you can lock in a 30-year fixed, right? So it's good for a period of time. So it is a bit of a tit for tat, where you're not building credit, but you are locking in a great investment opportunity with very low financing. So the actual nitty gritty of it, for those who understand it and think it's it is still involved from a buyer perspective, because again, you're taking the title, but the mortgage stays in the name of the seller. So unfortunately, you're not building credit, and you are technically still logging into that person's account and paying their mortgage on their behalf. That's a little bit of a workaround, but I would say it's many cases worthwhile to get that deal, to lock it up for now, wait for mortgage rates to subside, and then we refinance that onto a mortgage in your own name. But now you've managed to not only secure better pricing than you would, probably the best pricing you would in this market. But
oh no, you're not competing with that.
Yeah, you're getting like great prices, like historical prices, right, that like we could only wish we could get, right? So that's the subject 2, and then I think the cherry on top is with the seller. I think that was your case too, they stay on as a tenant. So that's like a win-win, right? You get to defer big renovations, you get the house as it is, and if the tenant stays for several years, which would be great, at that point the interest rates would drop. You then do the renovation, and the appraisal gaps are also probably a lot loosened up, and that's like a perfect storm. They vacate, you renovate, we refinance that, you get your appreciation, and you're probably hopefully made whole on that deal.
So just to take a step backwards, because this is almost like a unicorn deal.
Yeah.
Because you have a motivated seller. They're obviously motivated.
Yeah.
Because they're going to give up title, and they're going to still stay on the mortgage. So our client's going to get something under market value.
Yeah.
They're probably going to sit there. So if they were to get the mortgage, they're probably paying someone in the 7s, versus they're assuming maybe assuming is not the right word, but the mortgage stays.
Yeah.
And they're probably saving 3-4%.
Yeah.
On the mortgage rate, on the interest rate.
Yep.
And then they don't have to renovate up front.
Yeah. That's a big one.
That's a big one. They can defer. They don't have to come out of pocket as much if the sellers stay, which we're seeing those deals.
Yep.
Now you see the investor is getting rent right away, right? They don't have to wait. They don't have to risk any vacancy.
Yep.
Like, this is like a perfect deal.
Yeah, and
you facilitate this.
Yeah, and like if by chance the seller has less than ideal credit, because sometimes that's why they're selling, is like they're in a bit of a crunch. we know they're coming into some cash because we're buying the home, so we can ask for a larger security deposit to kind of hedge against anything. So it's
wait. What's the security deposit? We don't have these in Canada.
yeah, like you're first and last, but we will ask for something up front for more,
Right.
just because typically, like, what we don't waver on is the strength of your credit. Like, we will wait for longer periods of time to wait for that right tenant. So sometimes if the seller, we still make them do a credit run and background financial check. If they don't meet that criteria, we will go and ask for additional months of security deposit to make sure that we cover ourselves, and if we have to evict them, that we can cover ourselves in costs. Right?
I've seen some deals with like 6 or 12 months rent up front.
Yes. Yeah.
That's incredible security for the investor.
Oh yeah, it's fantastic.
And that's legal?
Yeah.
That's not here.
Oh really? Wait.
The tenant can offer anything they want. Anything under the sun, the tenant can offer you. You as the landlord cannot require it. Here in Ontario.
Got it.
Yeah.
Oh, we have it in our contracts. So if they wanted, that would be like a handshake off contract deal. Like
no, the tenant can offer you anything they want under the sun.
Yeah.
You just cannot make it. Me as the landlord, I cannot make it a requirement for getting the lease.
Interesting.
Right.
Huh.
Yeah. So perfect world, and this is a good pro tip for the listener, is get it on paper that the tenant offers you.
I see.
Right. Versus you're saying like you can just say I need 12 months rent up front.
Yeah. Well, we say like, look, you have to meet these conditions. They buy. They understand. You pay. You stay.
Do you see the difference between landlord friendly
That's
and not landlord friendly?
That's interesting. Yeah, that's that's interesting. I didn't know that.
Oh my god, it's so bad.
But yeah, the subject too is like the perfect storm, and we were like, that's sort of a hedge too that we're doing in this market right now, is and why we, to the earlier topic of like C and D quality homes, where interest rates and inflation are, those tenants feel it the hardest right now. So that's why we kind of guide clients and be like, look, A and B products are safe, they're resilient, let's go there. And in any case, wherever we go, A, B, or C, let's find something that's also leased, because for the same reasons we avoid vacancy, we can defer the renovation costs right now, and then the perfect storm happens down the road where they vacate after a few years, interest rates have dropped. We do the sort of the Burr Light strategy then, pull out a bunch of equity, and then go get another one.
Right. Insure does all the work.
Yeah,
I don't have to.
Every 12 months, we do an assessment on the property. Was there, rent rates, refinancing, on all of that, because we push every tenant to a 12-month renewal. So that is our trigger to assess the property.
Tell us about the renewal, because it's so different than here in Canada. Like, because here in Ontario, for example, I can't require the tenant to sign the lease.
Yeah, that's weird.
Like
after
renewal.
the 12 months, it has to be month to month, right?
No. The tenant can choose. They can go month to month.
Oh, really?
Or they can sign a new lease.
Oh.
Either way, they don't have to leave.
Right. Yeah. No. We force 12-month annual renewals. So come month 9, the property typically goes through a reassessment. Our property manager will walk the grounds,
right,
and then we'll make a proposal saying, "Hey, here, let's renew at this rate." But we don't do month to month.
Right. And the rate can be
as high as we want, but
right,
we go with market. I mean, if it's a good tenant, we just want them to stay. We don't want them to leave. We don't want hiccups. So that's why I think we're more human than, let's call it, the large institutions, right? We want a good tenant, keep them on. We'll negotiate a rate that's reasonable, and then they'll sign.
Right. They're not all heartless. Again, it seems that analyst calls for the big REITs is always focusing on retention.
Yes.
Right.
Yeah.
Like a business should be.
Yeah.
You want to retain the paying customer.
Yeah.
Versus here, we're like, get rid of the paying customer.
Yeah.
So they're ruining the investment.
Yeah. It's like it's like a purging of like pressure buildup in Canada. It's interesting.
It's so foreign, and I get it all the time with Canadians looking at the States. Like, yeah, it's kind of the Twilight Zone.
Yeah. So I can't believe this is my backyard. I'm always shocked about these new tidbits of laws that you share with me.
I can't even. So I remember there's one time I had a group of students looking at my property, and the mom that came was a lawyer, And I mentioned that, and I tell this to all my students, is part of the lease is I need a guarantor. And then the lawyer told me you can't do that. You can only do that if you ask everyone, right? And but this is student rental, so I'm always asking that. But again, you cannot always require a guarantor.
Yeah.
Unless you ask everyone.
Yeah.
Can you get guarantors in the States?
Yes, you can. I'm pretty sure. There's a whole service called guarantors where they will actually act as a third party. I think they're actually called theguarantors.com. Yeah.
It's a free plug.
Yeah. Yeah. Lucky them.
So I didn't mention this before, but we should cover this again because very common topic here. If tenant doesn't pay rent or does something bad to the property, say they have guests come over and there's excessive damages to the property and one window gets broken, what is the recourse for your client or the landlord?
Yeah, I mean, the damage will try to seek cost-effective ways to go through. So whether that's insurance, safety deposit, whatever that might be. But if the tenant chooses to be problematic, we will move to evict them. Yeah, like we don't tolerate vandalism very well.
What's the eviction process like? And also you have a security deposit, so it can come out of that. But what is the eviction process like?
Yeah, it's state to state or county to county. But typically, it again depends on what the issue is. But let's just say it's non-payment. They get repeat notices because a lot of these large institutions, they've got a lot of systems in place, right? So a lot of it will be automatic. It'll be like, hey, they missed. Boom, serve notice. You're late, you're delinquent. And then like fee structures start coming in aggressively in certain states. So all of a sudden we're seeing this person who is non-responsive or late on payment for like 2 weeks, and the system is telling them they've got to pay late fees and all of this. And then we've got to step in, like, just relax, like calm the machine down, reach out again, be a human, and then figure out what's going on. And then oftentimes they'll back pay or whatever it might be, or if they don't and we move problematic, usually 30 days is the larger window of time and leniency. If you haven't been working with our property management partner on payment schedule, then that's usually when the notice goes out, and then 60-90 days are gone.
What are these penalty fees?
It's like like interest. It's like late payment fees, admin fees. Yeah, they can tack on.
And how much are they? Because I think all we can do here is NSF, but even still, we still have to try and collect.
Yeah, no, there is a formula. I don't know it off the top of my head, but we know that we've actively had to say just relax on that because some of these institutions are hyper aggressive. And again, we were using institutional property managers and leasing agents. They can get hyper aggressive because they just got to go super fast. But we're like, okay, let's talk to them and see if we can change the structure to be a little bit friendlier and more conversational, so it's not just so adversarial all the time.
Right.
And it's not like it's adversarial. I think they've obviously done billions of dollars worth and they understand sort of the cadence, but at the same time we want to make sure that we have retention, right? And if there's a good story for it, then there's a good story. Mm-hmm. And especially in this market, you want to be understanding and work with your tenants.
Yeah, we're talking about this market. It's gonna get way worse here locally than down there.
Right.
People need to like read between the headlines. Like, we have all these what was it, Stellantis, I think Ford, and now Honda are changing production.
Yeah.
All in Ontario, all for the negative. And where do you think that production's going?
Yeah, have you heard of anything with the Chrysler one? Because I know like the Chrysler
in Brampton.
Yeah,
that's your backyard. You should know.
Yeah. So I do know, but I don't know the most recent. But I know that they shut that down because they were planning to retool everything for electric vehicles, and it's on shutdown right now. And they paused the timeline to reopen. But I'm pretty sure they openly said, oh, it has nothing to do with these tariffs. But
right.
I'm pretty sure it has everything to do with these tariffs.
I think the bigger part of anything EV, electric vehicle, is I believe Trump is doing away with EV credits. So that's not tariffs, but that's yeah.
But they are pausing the reopening and the building. So I don't know, maybe they're also trying to consider moving to the U.S. That would be a shame.
Hope not. Hope
Yeah.
not. Where else can we go? Oh, I had a question for you. I forgot. Oh, tell us about property management in the States. Because again, it's Twilight Zone. It is institutional property managers are, in my experience, are only available for institutions.
Yeah.
Right? They already have hundreds of apartment doors in their portfolio. It's very rare to find a property manager who will work with a mom and pop that has over 100 doors under management.
Yeah.
What is it like in the States?
Yeah, I mean, like, there are tons of small property managers, like boutiques, small mom and pop.
But as a business owner, I need redundancy. Like if my property manager fails me, and again, if it's a small operator, there tends to be some process mistakes.
Yeah.
Like for example, a friend of mine had a squatter in her property. Her property was in Atlanta and it was for sale. So the sale sign's up. So then squatters know.
Yeah.
Squatter broke in. Her property manager / realtor. So again, someone that wears many hats. Told my friend, you need to hire a lawyer, right?
Yeah.
Like, okay, so you've kind of failed me here.
Yeah.
You know what I mean? And also they're passing on the buck.
Yeah.
Right? Now, I want to focus on my other stuff and not so much focus on landlording stuff.
Yeah.
Well, what's it like in the States with an institutional property
Yeah,
manager?
with the institution, like, you can imagine that all of the edge cases that would happen with like a small boutique property manager is probably normal operation for them. Their edge cases are super edge case. And when an edge case means like very unique situations, right? They have process and protocol for everything, and everything is formulaic. So we actually know what they're supposed to do and how they're going to react and how they present things to us to be in a hyper efficient way. Because like, again, if you're a property management service provider and you're working for an institution, they're watching the second decimal place on everything, right? So
you telling them to call your lawyer is not acceptable.
Yeah, it's not. Like, they need to have ready baked solutions. They've been exposed to every single scenario 1,000 times over, right? So they know how to handle things. They've got people in their network. They've got things, and then it comes through the ways of financials to us, to like, here's what's happening, so we can actually talk about 1,000 properties way more efficiently than talking to like 10 small boutiques, like in spread out, because they just speak the same language. Here's what's happening, here's a course of action, here are the costs, right? Where sometimes with a boutique, you're like telling them, here, go to this, and they're going to say, I spoke to this plumber and it was the first one they talked to and it was not cost effective. Whereas institutions will be like, well, we've got a lot of buying power. Here, HVAC system went. We can go brand new, or we know the distributor in this area. We can get a used one, which will be better for you. We'll replace in 8 years, and we've got a better insurance policy, and that cost is way better, right? If we just pay for this additional insurance, right? Or look, it's storm season. Maybe we just wait for a next rainstorm, and we'll patch the roof under insurance. So there's a lot more understanding of how the system works, and they've seen the system, or they've seen every single scenario 1,000 times over. So for them, it's very formulaic, and same with us, with Dimitri and Ben's background of dealing with billions of dollars of units. They've seen every scenario, so they kind of know how to act.
Oh, we were talking about. I remember what I wanted to ask you about earlier, because we were talking about like small multi-families and units and not so desirable places. The property manager will tell you if they'll manage it or not. And my thing is always like, if someone's not willing to take your money to work, there's probably something wrong with it.
Yeah.
It's like my friend that, for reasons that you can probably guess, the insurance company won't touch him. Right? Someone won't take your money, eh? There's probably a problem. It's the same thing if the property manager won't touch the property. Like, what do they say? Like, say you sold them a fiveplex that are $50,000 each unit.
Yeah.
What would the property manager say?
So I think the way you want to look at that is, I think a good experiment would be go shop other property managers and be like, what is the delta of the range, and then find out how the lowest price point came to that conclusion, because the truth is there's a reason why it's such a high variance. If somebody is willing to take it on and they say, well, here's a custom price, and it's higher, like 10-12%, there's a reason, because they know they're
danger
getting
premium
called every single day. Oh, my light bulb doesn't work, or this, like, have you heard of the light switch? So, a good exercise is shop the property management companies, and most likely the highest one, actually not, I'll take most likely, but find out why it's so high and find out why it's so low.
Yeah.
Because, and then if they say no, then you just know that you shouldn't be going there.
My friend Carlos came on the show. We haven't released it yet, but I think he told me he had to call. He called 8 property managers and they wouldn't manage the property.
Yeah.
Like, doesn't that tell you something?
Yeah, that's a non-starter. That is a non-starter.
If you're willing to do it yourself, like, go for it. But like, again, risk tolerance, effort tolerance. Like me, I'm on. I've done this long enough. I know where I want to be on that scale.
Yeah.
I don't want again, as a business owner, I want redundancy. So I want, when people ask me how's your property going in Texas, I'm like, I haven't heard a thing.
Yeah.
That's exactly what I want. Yeah. Other than my monthly email, you have positive cash flow.
Yeah. And like that was an earlier question, was redundancy. Is like, we work with a ton of, we have redundancy on almost every service provider. And they're hungry for business. They always want to, there's this big service sector built for institutions. So all of our contracts are non-committal after a certain amount of months. So they want to make sure we're happy, or else we take the portfolio and leave.
Right.
Yeah.
Again, twilight zone.
Yeah.
Because property managers here, actually, I think more of them have capacity now, but just because so many people have gotten out of the business.
Right.
Yes. I've just heard from enough people that they've lost. That a lot of people don't have enough cash flow in their portfolios to pay property management. Right. Versus, the States, it's so much more affordable.
But here, isn't the property manager collecting the money first?
Oh, yes, but if at the end of the day the client's negative cash flow, they're going to be looking for cost savings.
Right.
So who do they let go?
Right. Interesting.
So I've seen many people let their property manager go for that reason, just to preserve cash flow.
Got it.
They're already negative, and then this may get them positive, or at least maybe get them less negative.
Right. Yeah. That's the majority of our Ontario clients. They've self-managed in order to kind of make ends meet, and they even still, like, I use make ends meet loosely.
Right. And self-bookkeep.
Yeah.
I tease people about that.
They do a lot. The Ontario landlord does a lot. I'm surprised. They're like pseudo accountants, they're pseudo lawyers, and they're pseudo crafts, like tradesmen. Like, it's pretty impressive.
You have to be.
Yeah.
And they're pseudo property managers, and they're pseudo legal experts, because you need to know how the system works for tenants in Ontario and BC and Quebec. Otherwise, you open yourself up to a whole bunch of liability.
Yeah.
Right.
Yep.
What else haven't we talked about? We were talking about before. Actually, you came up with a number. We're talking about the Sunbelt, for example, because Sunbelt gets a lot of negative headlines around real estate. But I was telling you this morning. So currently, Sunbelt is the southern U.S. and currently it's 50% of the U.S. population. By 2024, it's going to grow to 55% of the U.S. population. So we're going to see migration and I guess some level of immigration as well. So that number works out to 21% population growth of the Sunbelt states by 2040. And it's funny because, again, like, I've had so many people like talk negatively about the Sunbelt. I think probably because Florida's included. So we can talk about a little bit of Florida before I let you go, just because of all the wild things going on in Florida real estate between hurricanes and condo prices having come down significantly. Where should we go? And also, we haven't even talked about the U.S. housing shortage gap. I've seen this in the headlines quite a bit. 4.5 million U.S. housing gap in houses. Where should we go next?
That's the resiliency piece.
Yeah, because again, like, people forget real estate investing. It's a business. Yeah. You buy what's in high demand and short supply.
Yeah.
There's a shortage of 4.5 million houses in the States.
Yeah.
And costs are only going up to build.
Yeah, and like I think on top of that, you have increasing number of renters for that reason.
Right.
And if the job market becomes as geographically spread as it is today and continues to be, you're going to have more families moving cross country, in migration. So that shortage is still, I don't think they'll ever be able to catch up. And that's why you're going to have this. There is a stat that renters are going to outpace homeowners in the next like 10, 15 years. So that shortage is going to just make this. The shortage is what's making the single family rental such a resilient asset class. And because people prefer to live in a house over a condo. So yeah, that will only make that. It's why institutions have like billions of dollars in their war chest, and majority of the inventory coming to market, or not majority, a vast number of the homes that are coming to market are purposeful built rent homes, built for rent, built to rent homes. So it makes anyone getting into single family today that much stronger.
I think most people, if they just look at their own family histories, where they're from, and look at where real estate's done. Like, you're Korean, I'm Chinese, Hong Kong, so I've seen what real estate's happened there, how it's become incredibly unaffordable. I'm pretty sure like Seoul is pretty much the same.
Everyone rents. Yeah.
Everyone rents. Housing is extremely unaffordable. I watched what was that show on Netflix? What's the show on Netflix? The really
There's a
big
million.
one. No, the
definitely
one,
wasn't Squid Game.
Squid Game. Yeah.
Oh wait, what was?
Yeah, because life is so miserable.
Yeah.
Because it's so unaffordable that people would rather be in Squid Game.
Yeah.
Right.
Yeah.
Because that was the base of the premise of the show, not just how nuts Squid Game is. But my point is, like, we've seen this in pretty much every major European city, like London, Munich, like name it, Paris. Like, they're all crazy expensive, and so then all future generations only rent.
Yeah.
And that was my fear for Canada. I think we're already there now.
Yeah.
All future generations will rent unless they have rich parents, and the Americans are fearing it now too.
Yeah.
Well, they've already seen it in like expensive cities like in the state of California and New York City. Like, we've already seen it.
Yeah.
Where it's not affordable, and now the Americans are starting to worrying about that too.
Yeah.
Right?
Yeah.
So my point is, like, we've seen this historically happen all the time. So what do you think you should do?
Yeah. I think what's unique though about the US too is that, like, the job market brings people around the country too, and for them renting is often easier.
Yeah.
Right. So now you've got a working professional that wants a single family home versus it be a byproduct of an affordability issue, but you got both, right?
Yeah.
So again, the strengthening of all of the resiliency factor of single family rental is only getting stronger over time.
Because I get the question all the time about why would someone rent when the house is so cheap?
Right.
But then I always tell them, let's say you work in microchip manufacturing.
Right.
Right? We're going to work in Canada. There are no options. Whereas in the States, you have Intel in Columbus, Ohio, building their factory. Samsung, just outside Austin, Texas. Texas Instruments, just north of Dallas. TSMC, which is just doing nuts, not crazy amount of stuff. NVIDIA's doing some new stuff in Texas that they just announced as well. So you have like 5 affordable places to live.
Yeah.
So I'm like, when you're taking a job, you probably want to try it out.
Yeah.
See if you like the city, you like the job before you decide to buy anything.
Yeah, 100%.
So they'll always have these people. And then when Cher sent out the deal in Taylor, Texas, which is just outside Austin, Texas, I've shown it to a couple of people because it's just absolutely nuts. Again, Twilight Zone. So $245,000 for a 3-bedroom, 2-bath, 2-car garage house with 1,400 square feet. $245,000. I believe that's $170 US per square foot, or about 240 Canadian per square foot.
Yeah.
Again, so like a quarter of the cost of a condo in Toronto in terms of square foot cost. So then I explain to people, I back out the Google map and I said, okay, see that huge, so anyone who's doing this, like listening, want to fact check me, look up Taylor, Texas, and then if you just look what's next to Taylor, Texas is Samsung. There's a humongous gray-white property, and that's Samsung's $65 billion investment to build 3 microchip manufacturing plants. So then I'm on Samsung's website and I'm feeding it to ChatGPT. What is the median salary at the Samsung plant? Because it's supposed to create 5,000 permanent jobs.
Right.
Do you want to guess what the median salary is for a Samsung employee in microchip manufacturing?
What is it?
$96,000.
Oh, man, that's great.
What company in Canada has a median salary of $96,000?
Right.
Right, and that's American.
Yeah.
Right. So that's about close to 140 Canadian, which is close to double the household income of a Canadian.
Mm-hmm.
And the house they can rent from us is only $245,000 or $1,800 rent.
Right.
Very affordable.
Yeah.
What's affordable here?
Yeah.
Crazy, eh?
Yeah.
Twilight Zone.
It is Twilight Zone.
We should title this show Twilight Zone.
Twilight series. Trademarked.
You mentioned a lot of cross-border complexity. At least that's how Canadians are feeling. Can you touch on that?
Yeah, I think Canadians, there's two things. There's financing and then there's taxes. They always get hung up on the two. Financing, I know we talked about, we could always circle back. Endless financing. Taxes are always worried about this concept of double tax. And if they're worried about that, they should also see Cherry's channel. But, there's a foreign tax treaty that, if we were to sum it up in one liner, it's no different than investing here in terms of like what you're going to be paying for taxes. So you're always going to be paying the higher of the two countries' taxes, right? So in this case, many cases it's the Canadian tax system that will sort of outpace the US. And the example we always say is like whatever you're paying on the US side, that they say, hey, look, you have capital gains of $5,000. Canada says you owe $4,000 and the US says you owe $1,000. Again, just arbitrary numbers. You will pay the $1,000 on the US, but then when you file your Canadian taxes, you're going to tell them I already paid $1,000. So you're only paying them the $4,000. So it's very similar to investing here. You are made whole and you won't be double taxed in that sense. Again, if you're doing your bookkeeping right and your entity structures right, everything should fall in line. So yeah, investing in the US is no more onerous than in Canada.
Again, I think it's just an educational piece.
Yeah, and the returns are worth it. So, and then you get depreciation on the US side, so the rental income almost looks like nothing.
I think we agree on this. I think when someone asks how much the money they need to start investing in the States, I think 100,000 Canadian is reasonable.
Yeah, 100,000 Canadian.
And then what do they get? What do they get for 100,000 Canadian?
Yeah, you could probably get, depending on the strategy, if you were to go lease back or subject to, you could probably get like a C plus property or a B minus. And then, we would look at different strategies and look to get some equity out of that. That typically means we are going after a home with a mortgage, DSCR loan. So that's the capital with DSCR, or with a very good subject to deal like you got, where you're now inheriting the mortgage. But that typically means we're locking in some sort of financing vehicle, which in this high interest rate environment only means that, we're going to recoup that cash once and refinance once the rate goes down. So higher premium to play today just because of the byproduct of the higher interest rate on the mortgage.
But again, we can get someone pretty much all day. We can get someone into a subject to.
Yeah, pretty much. Right. Subject to lease back, stuff like that.
Which would be, wouldn't that be the recommended strategy in today's market?
Yeah, we're doing that to everyone to avoid sort of downtime today in this market.
Yeah. And also to save on the interest rate.
Yeah, exactly. Yeah.
Andrew, we're running out of time. Anything else we should cover? Anything else I'm leaving out?
What else do we have on there?
Oh, exchange the Canadian dollar. I find that comes up a lot when talking to Canadians. And then I should bring it up more often. Like, what do you think? How do we get back to par? I think I should ask people that. Yeah. But then I'm a bit of a jerk.
I don't know if I'm equipped to handle how do we get back to par, but the often question is, do I wait till the Forex, the exchange rate equalizes or it goes back to normal before investing? And so I think we did this bit of a sensitivity analysis and we said, let's look at the last 10 years, okay? And what's the worst and best scenario? Worst is just what we faced. It was about 70 cents on the dollar, Canadian to US. And then the best was 82 cents, right? So you're talking about 12 cents. right? So if you draw the line down the middle, was it 6 cents? And then when you look at back into 6 cents on your down payment of, let's call it $100,000 Canadian, that's not that significant of a needle when single families are a 10-year plus play, right? So what is that going to really hinder on your 10-year return? But what other people are not considering is that this asset class does not depreciate, like it doesn't dip. It appreciates and appreciates, and it's continuing to appreciate. So there's a line of, waiting too long for your foreign exchange where you're going to start losing more money on the appreciation and you're coming in at a higher price point. So our whole thing is like over 10 years, it's over a 5-year period, it's nothing. You're probably losing about 1.5 years of appreciation. So don't let that be a hindrance. And if the dollar does get worse after you purchase, it's odd how we see that emotion flip. Canadians that were worried about the foreign exchange and they buy, and now they're like, let's go US dollar, and all of a sudden they're paying back their loan or recouping their capital way faster. So it's a timing issue, and it's like, but you're going against appreciation, so which one are you going to gamble against?
I don't mean to just focus on that subject too, but I think it because of where we are in today's market, and because the market's softer, and this is kind of like the ideal strategy.
Yeah.
And again, like folks, like where can they get a subject to without really doing any effort?
Yeah.
And they own the house.
Yep.
Right.
Yeah.
Because for the listener, think about how much work you have to do to find a subject to seller.
Yep, and negotiate with them, do the underwriting, and bring it back to their face. And like, oh, you should sell it for a little less,
Yeah, and let me take title while you carry the mortgage.
Yeah.
Right.
Yeah.
Like I've never seen anyone do this on scale in Canada.
Yeah.
Partly because of our market as well.
Right.
Right. Because generally people want their money. They want to sell because they want their money.
Right.
Here we're keeping the seller to the mortgage still.
Mm-hmm.
And again, like the client doesn't have to do anything.
Yeah.
Like my experience was, Share brought me the deal.
Yeah.
I just had to review it, sign documents.
Yep.
Like the down payment, no different than anything else.
Yeah. Well, it's significantly smaller than what you would normally pay for your quality of house, for sure.
We should probably talk subject 2 more.
Yeah.
Yeah, and again, like the client owns the house.
Yeah.
Right. Andrew, thanks for doing this. Thanks for being so generous with your time.
Thanks for having me. It's always a pleasure. It's always good for me to learn about the Canadian real estate market.
All right, friends, that wraps up another episode of the Truth About Real Estate Investing show for Canadians. Hope you got as much out of this one as I did. Remember that whether you're just starting out or a seasoned investor, there's always something new to learn, and it's always about building that practical knowledge base that gets you closer to financial freedom. If you found value today, please do us a favor and leave us a review or a rating, share this episode with a friend, or better yet, join our community of real estate investors who are taking action and making moves. And hey, if there's a topic you want us to cover, or there's a certain guest you'd like us to have on the show, drop me a line. My DMs are open on social media. Reply to this email that this has arrived on. I'm not hard to find. We're all about getting you the unfiltered truth to help you on your journey. Thanks again for tuning in, and we'll see you in the next episode. Until then, stay smart, stay curious, and keep building that future. Catch you later.